But right now, we're going to focus on one of the largest conglomerates in the country, Mahindra and Mahindra. And we have with us a very special guest who's with us in the studios, Anish Shah, CEO and Managing Director at Mahindra and Mahindra. Anish, great to have you with us here. Thank you very much. I dare say you're one of the most loved CEOs, especially from an investor perspective, Anish. I was looking at returns. Since you took over, stock's up 4 times. We can say markets have done well, but that is still astonishing for a company that size and what the stock has done. So congratulations. And congratulations on a superb set of results once again. I want to start with the tractor business because volumes in the June quarter were flat. They were down earlier. They were flat. You're guiding for a 5% growth for the full year, FY25. Monsoon rains are good. I mean, they've gotten better. Could we be at the end of a down cycle, beginning of an up cycle? Your thoughts?
So, Prashant, first, thank you for the kind words. We've done a lot of great work as a team, so I would say all the credit goes to our teams. And we've got a very strong operating rhythm. On tractors in particular, we are seeing green shoots, clearly helped by the monsoons, but beyond that, government spending is up in rural areas, and therefore we do believe that we should be out of the down cycle now. The second half should be fairly good as well. Navratri comes in at that point. So we're in a much better place from a tractor standpoint.
And if the down cycle is ending and an up cycle is starting, as some are pointing out, could it last? I mean, someone was saying that the up cycle usually lasts 3-4 years. I mean, it's not 1 quarter, 2 quarters, but once it starts, it continues the momentum. Is that a fair assessment?
That is what we have typically seen. So that's something we would look at as a fair assessment based on history.
Would you like to raise that guidance for 25 a little bit, just a tad bit for right now?
At this point, we feel 5% is a fair guidance.
With upside risk?
As I said yesterday in a press call, taking cues from the Fed governor and the RBI governor, we'd say there's an arrow that's pointing towards the up, but we're at 5% for now.
But at least, we're past the worst when it comes to tractors, overall industry and for M&M, and the growth is going to sort of sustain and continue?
For M&M, we've seen growth very substantially, even in a flat market. A tractor market share in the first quarter was up 180 basis points, which when you're in the 40s is a fairly tough thing to achieve. So not just tractor, LCV was up 160 basis points, SCV up 130 basis points. So from an operating standpoint, we've been fairly strong.
No, absolutely. And now I want to come to the cool business, which is bread and butter and SUV. Your leadership, your dominance continues, and I think the market share has only increased even in the quarter gone by. I just want to quote a figure from one of the analysts on the street, Jeffries. Now their projections are they're expecting your auto volumes to show sustained 14 to 15% CAGR over the next 2 to 3 years. I mean, going up to FY27 with dominance. You think these are fair estimates, or do you think you're going to surpass them by a mile?
So the guidance we've given for this year is mid to high teens growth. And the first quarter was 24% growth. So you can extrapolate based on that.
So 15% CAGR next 3 years, auto business?
It seems reasonable in a sense based on the trajectory we have right now and the demand that we've seen for the models right now.
Okay, all right. Hi, Dr. Shah, and thanks a lot for coming down. Besides the shareholders, I was speaking to some of your employees as well. They as well seem quite pleased, so that's good news, I think, so when the home is happy. But let's talk a little bit more about SUV. As you said, you all have been growing quite well. I think the market share as well has been moving up. What's the rough market share that you're headed to, say in FY25 and then FY26? Because you have been guiding that you're going to outgrow the industry.
I think it depends a lot on how the industry will move. The auto industry has been relatively benign and flat for a while. Not exactly flat, but still growing at a slow pace. With India growing the way it is right now, there is a potential for an uptick there at some point in time.
Right.
Now, when is that going to happen? Your guess is as good as mine on that. Which is what we'd have to wait and watch in terms of where we go.
All right, but SUV, I think you were at around 15%. It's moved to around 18% as of last reckoning, right?
Yes, from a revenue standpoint, which is what we look at, we are at 22% now from a revenue market share perspective.
Okay, all right. And also, if I had to focus on your margin picture, there were some price cuts that I think you took in the XUV 700 segment. But you have been changing your mix. Some part of that mix will be margin accretive as well. So from here on, will margins improve as a consolidated entity?
So we've seen a significant jump in margins in this quarter. And yes, that is a question we've been getting from a lot of our analysts as well. We are putting a lot of effort in to enhance margins. There will be positive and negative pressures to that. So for now, we're essentially saying that we will continue to maintain where we are. We will continue to see some improvements over time. But we also use that in a way to manage both growth and margins, and which is where we decided to have a price cut, because we had increased prices significantly over the last 3 years as a function of commodity price increase, as a function of concerns and issues with semiconductors. As that has eased, it was important for us to pass that benefit back to consumers as well and drive growth. So that is a combination that we will continue to look at, and which is where it's a management of both margins and growth.
You know, on just to continue with the SUV side, for the last couple of years, we've all focused and fixated on the bookings. But the bookings number has come off a little bit. But I think that is also because waiting periods are now lower. I mean, is that the way to look at it?
Yeah, so the main thing there is capacity. Right? We've gone from 19,000 SUVs a month to 49,000 today. And at the end of this year, we will be even higher than that. So we've, at this point, got almost a 3x increase in the last 4 years. Capacity was difficult for us to put in 2 years ago because of the semiconductor issue. We actually didn't like having a long booking pipeline. It's not good for the consumer. And the cost of putting capacity is not that high in the overall scheme of things. So for us, our goal is to try and keep that booking number down as much as possible. Not new bookings, but the backlog, and therefore be able to give consumers a car as quickly as possible. So that's the reason why, yesterday we stated that, look, that's the last time we'll talk about the backlog, because we're starting to get to a point where with increased capacity, we can start meeting that backlog very well.
And capacity is going to be good for, of course, depends on growth and underlying market dynamics, but your sense?
We still plan to increase from here. We have talked about going to 64,000 from here. So that's something that we will continue to do, because with the 5 Thar coming in, we will need more capacity as well. And that's part of what will come in.
In terms of the powertrain or just the vehicle itself, right? There's ICE, there's electric, and there are a lot of electric launches happening. I know you've been quoted in the media, on hybrids. But what's the thought process? And from the company standpoint, both volume and profitability, how do you think this will play out? Because let's face it, I mean, electric vehicles are more expensive than ICE. So as those launches kick in, do you think that there could be a bit of a dent in volumes just because of the pricing element there? And I don't know, I mean, hybrids are, if they even make sense, there are some states offering incentives on it. So just in terms of technology, what are we looking at over the next 2 years in terms of the product mix, how you forecast the market?
So let's look at why EV is important. If you think about it from a government or a policy standpoint, EVs solve 2 major problems. One is pollution in our cities, and second is a fuel import bill. So both of these are not really addressed by hybrids as much, and which is why governments around the world have found it very difficult to provide incentives for hybrids for the last 20 years. Hybrid, again, is a powertrain. It is more expensive than ICE. The question is, are incentives required there forever if we have to move there? For EV, that's the other advantage. You may not need incentives forever. And if you take the example of electric three-wheelers, the FAME 2 program was very well designed, and that created a stimulus for electric three-wheelers that has gotten to 20% penetration as an industry. And that will go to 100% in the next 5 or 6 years. So that is essentially a very successful use of incentives, because in that time frame, by 2030, we will not need any more incentives for electric three-wheelers.
What about four-wheelers? What would you like the policy to be as we get more and more, EV four-wheelers in the market, your portfolio included?
For four-wheelers, we feel the government has provided all the incentives required. With the PLI scheme that's in place, with the GST program that's in place, there is nothing further required from an incentive standpoint, right? And over time, that will come down as well as four-wheelers expand. What is essential for four-wheelers is a charging ecosystem. And that is one area where we know that the government is very focused on it. They're looking at various different ways to enhance the charging ecosystem. As that happens, we will see four-wheelers start taking off, because it starts with the product. You've got to see the product and say, I love this product. And then you start thinking of charging. And if you have the charging infrastructure behind it, then it's much easier to transition to four-wheelers.
But just coming to complete this point, to come back to that question on pricing, because EVs are priced, above ICE models. How do you expect this to play out, consumer behavior, and in terms of your own targets, in terms of growth of the M&M EV portfolio, what do you forecast this year and say next year, in the near future?
So we've got our born electric vehicles coming up starting January. And I can tell you that I'm very excited about those vehicles, and I'm looking forward to driving them. Incentives have to play that role to bridge that gap in pricing. Because if the pricing is far higher than ICE, then electric is not going to take over. So we feel that incentives have done that job, and that the pricing will not be dramatically higher than ICE. And that will help us transition to electric, and over time the cost of electric will come down, and incentives will come down as well.
Okay, all right. Mr. Shah, what about the new launches? I think the street is looking forward to the 5-door Thar. When does that come into the market? And also, what are the rough estimates you're looking at there in terms of demand?
So August 15th is the date for the 5-door Thar. And we are very excited about it. It has come out extremely well. And in terms of numbers, we'll just have to wait and watch. We'll have to see what consumers think of this.
By the way, Surabhi was saying, moving on to the cooler business, right, for SUVs. I was thinking tractors are cool.
Of course they are.
I've always wanted to drive one, but I've never got the opportunity.
Actually, you could be looking at it, in a very, very different manner.
Anish, I just want to step back one bit, right? And I began by saying investors and markets see you as the value creator. So when you think about what next in terms of value creation from an investor point of view, one thing, it's not new, it's been sort of, you've been asked this before, is demerger. For autos and tractors separately, because the company still gets a holding company discount. Is that on the anvil? What's the internal thinking on it?
So this is a question we've faced for a few years now, and the response has always been, first we're going to focus on inherently creating value with better products, with better execution, and that's something we've done. In many ways, there should be a benefit given to companies that are together and generate synergies. Today, we've got obviously much higher margins in farm than anyone else because we've got a higher market share. But our auto margins are very well placed in the industry, even when we may not be the number one in the industry. And that's because of the synergies we have. Purchase synergies are significant. Technology, talent, there are a number of other synergies that we have. And therefore, what we're looking at right now is, can we showcase that as an advantage for the group? And we already have certain analysts talking about a conglomerate premium in our recent analyst reports. But that is really what we think we can be able to showcase.
So should I take that as at least in the immediate future, I mean, no? I mean,
Not happening.
In the immediate future, no.
Right.
But at some scale, would you like to demerge both the entities?
For us, if it makes sense economically to do that, we will.
Is there a scale in mind?
It's not a question of scale. The question is there more value for it together than apart?
Okay.
Right now, you see more value together.
At this point, we see more value for it together.
Because if you look at, say, I mean, and back in the day, escorts, for example, used to, the valuation, it used to get a higher valuation compared to the implied valuation for the tractor business here. Maybe it's now closer, much closer. Maruti, Hyundai is going to be listing soon. Average P multiples of 30, 35 times. I mean, conglomerate premium, that may happen in the future, but as of now there is that discount. So that's the reason that's the point where I'm coming from. But you're saying we're not there yet.
We're not there yet. We are seeing that discount reduce. As I said, we've seen the first analyst report that talked about the conglomerate premium just 3 months ago. And it's coming from the fact that we're starting to show greater value in our businesses. So to me, that's a fundamental question. How can you create greater value? Is it by being together and having intrinsic value that's greater, or being separate? And if the answer is being separate, we'll look at it. But today, we don't believe that's the case.
Okay, so Anish, we've spent a lot of time speaking about auto. Allow me, as we wind up, to request you to wear your other hat as the head of Tech Mahindra as well. The reason we're bringing this up is, I know it's an issue specific to a different entity and company right now. I'm sure you've seen the headlines. Tax demand notice, a rather big sort of notice that's gone to Infosys in terms of how overseas branches need to be treated from a tax perspective. Just as you see, you've already laid out a roadmap for Tech Mahindra in terms of improving margins. Just leave us with an overview. I think the margins as of this quarter were 8.5%. How you see that trajectory play out? And indeed, if such notices start going out to some of the marquee companies, is it any reason for worry from a sector standpoint, from a tech industry standpoint?
So, two parts to that question. First, we see Tech Mahindra on a good path of recovery. This is a business where we've talked about a 3-year turnaround plan. We've outlined the plan as well. Similar in many ways to the plan we'd outlined for Mahindra Finance a year and a half ago. And Mahindra Finance is on a very good track. Now we've seen fantastic results this quarter, better asset quality, strong growth, a lot of work on the technology side. So therefore, TechM will continue well on this path. Phase 1 is to get back to the margins that we were at, which is a fairly short time frame. And then the phase 2 is to look at 500 basis point margin expansion beyond that, which again has been outlined in the plan. So we feel good about where Tech Mahindra is with the new team, with the delivery mechanism that we put out there. And the second part to your question, look, we feel that the government has always done the right thing in terms of making it easy to do business with. So I'm sure that that is something that will end up in the right place. I don't know the details of the facts, so I can't say anything more at this point.
Got it. Anish, pleasure speaking with you. Thank you very much for taking out the time and being with us here in the studios.
Yes, in person. That really counts.
And I hope we can do this more often here. So much better. Thank you very much.
Sounds good. Thanks for having me here today.
Thank you. All right, well.